Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Thursday, November 13th. We have got a great show lined up for you today. First up, Lyft shares are actually outperforming Uber shares this year. Our financial analysis columnist joins us on the show to talk about the factors behind Lyft's turnaround. We've also got a great conversation about AI agents lined up for you with a Snowflake executive, and we're talking about the state of electric vehicles charging infrastructure with the CEO of Loop Global. And finally, we'll finish things off with a funding update from a startup on this year's TI50, our list of the 50 most promising startups. It is a big show, and so let's get right on into things. Uber's market cap is nearly 20 times more than that of Lyft's, but a little known stat that may interest you, Lyft shares are up almost 80% this year compared to Uber's 50% jump. Both companies are clearly doing well, but today, my colleague Anita Ramaswamy published a column breaking down how exactly Lyft has turned itself around over the past few years and what it could mean for the future of the company. It's a great column, and so I want to bring on Anita to talk all about it. Anita, welcome back to the show. It's great to have you here.
Hi, Akash. Great to be here.
So let's talk about Lyft. Why are Lyft shares doing so well this year?
Yeah, so this is a little bit surprising to investors, Akash, and to the market more broadly, because Uber is a lot bigger. It's always been seen as sort of the number one competitor in this space, and many investors have a thesis that it's sort of a winner-takes-all space. And Lyft really broke out of that narrative this year for a couple of reasons. They got a new CEO in 2023, David Risher, and he came from Amazon, and he's been implementing all sorts of changes at Lyft. And the biggest result that he's delivered so far, in my opinion, is that he was able to turn the company into a company that is free cash flow positive. So he's cut costs. He has actually used some of the excess cash Lyft had on its balance sheet to do some acquisitions. So they bought a luxury chauffeuring service this year. They bought a European taxi app, which kind of marks their biggest international expansion and their first initiative outside of North America in a while and ever. So that's, one other reason. And he's also cleaned up the cap table. There was a big controversy around the dual class share structure that Lyft's founders had. And he managed to work with an activist investor and resolve that issue as well.
So he actually worked with activist investors. A lot of CEOs, sometimes they get scared of activist investors. They say, look, let me do my thing over here.
It's funny. It was like a couple weeks of an activist campaign, one of the shortest activist campaigns that I've ever seen. And, it resulted in Lyft upping its share buyback program, making that bigger, and also resolving this cap table issue. But it was just sort of funny to see that it was less than a month long.
David Risher, he's an interesting guy. He does a lot of podcasts, I have to say. I don't know how many of them you've listened to, but he's really done the circuit. So let's talk about how Lyft compares to Uber's business. These are two companies that at one point were rivals. Now Uber is obviously much bigger. But how does the way that Lyft has been running their business contrast or compare with that of Uber's?
I would say the biggest difference, Akash, was in the past, Uber was international, Lyft wasn't. So that's one thing that has started to change. But the biggest difference today is actually the Uber Eats division. Lyft has focused singularly on ride hailing. David Risher has been crystal clear that that is the only market that he's focused on right now and doesn't have plans to expand into anything like food delivery or grocery delivery in the same way that Uber has. So while Uber is a lot bigger, it's got 8 times the revenue, generates 9 times the cash. It's also grown a bit faster in the last couple of quarters because Uber Eats has been growing really nicely. The advantage with Lyft is that David Risher and the team there are focused only on ride hailing. And that's where they've done acquisitions. That's where they have focused all of their growth initiatives and new features as well.
Now, what about the threats that face the ride-hailing sector at large? The elephant in the room is autonomous vehicles. It's been a big week for Waymo announcing their cars will be on highways. Has Lyft talked at all about the ways in which it's approaching that paradigm shift and the ways in which it can actually latch on to that trend?
Yeah, this is a big sort of risk looming over both Uber and Lyft in different ways. And the way that Uber had addressed it is they started doing all these partnership deals with different AV firms. So they did deals with Waymo in Austin, Atlanta, and Phoenix. They have partnerships with a bunch of other different AV players that are on different parts of that autonomous robotaxi stack. Lyft was less successful in making those partnerships early on, but in the last couple of months or so, they have started to turn that around. And one of the key reasons is they are doing a deal with Waymo in Nashville to bring robotaxis to the Lyft network there in 2026. And what's unique about Lyft's approach is that they actually own a fleet management company called FlexDrive, something that they bought in 2020 to help service, clean, and maintain their fleet of cars. And they are going to be applying that subsidiary and its capabilities to autonomous vehicles. So it's really important, Akash, in AVs to make sure that your taxis are being used all the time. It's important in regular ride hailing too. And in order to boost that utilization and make sure the cars are being turned around quickly, cleaned quickly, getting back on the roads quickly, that fleet management service, FlexDrive, is going to be really crucial for Lyft, in my opinion.
And so your view actually is that Lyft is approaching the autonomous vehicles challenge a little bit better than Uber, if I'm understanding you correctly.
Yeah, that's right. I mean, Uber has been tremendously successful, but I think it is a true differentiator that Lyft owns this part of the stack. If you think about all the different components that go into robotaxis, and if you assume, as if you're an investor who believes that these are really the future and they're going to gain mass market popularity, I mean, we just saw yesterday that Waymo expanded in the SF Bay area.
Mhm.
There's been a lot of early points of validation to the business model and that there is real demand. So at that point, Uber is positioned right now as a platform that can just bring demand to those already existing AVs. If the AV companies like Waymo can get demand on their own, then it's not clear to me where Uber is doing something unique and differentiated. Lyft has built that capability out in-house. Uber can always acquire a company that does fleet management. They can always do some M&A and find some other way into the stack. But at least for right now, Lyft is building this capability and has been working on it since 2020 from the ground up. And I think that's going to be an advantage for them when it comes to making deals with other sorts of AV firms besides just Waymo or deals in other cities.
Now, you talked about M&A, you talked about acquisitions. We rewind the clock. At the end of last year, you made a prediction that Amazon was going to buy Lyft, and it hasn't happened yet. We're not saying it couldn't happen, but where do you stand on that? Are you re-upping that prediction that you made last year? What is your prediction for Lyft going forward?
Not quite, Akash. I guess, sometimes the crystal ball doesn't work perfectly.
Yeah.
But, the rationale there, I think, still holds up and makes sense insofar as both Lyft and Uber have a lot of demand and, heavy ridership, millions of riders on each of the platforms. And I think when it comes to the autonomous vehicle race, we are still very early. So, Waymo looks like the winner right now, but we all remember what happened with GM's Cruise. We all remember, so many of these different companies that were not able to move forward. And I think that the field of players is going to shift really rapidly. So I think it's possible that Lyft is either acquired or an acquirer of more of these startups as the technology develops.
Great. Well, Anita, it was a great column. Thank you so much for coming on the show. I appreciate it. And I should say, David Risher, if you're watching this, I know you're on the podcast circuit. Come on our show because clearly we're watching your company very closely. But in the meantime, thank you, Anita, for coming on. I really appreciate it.
Thanks.
Okay. We talked yesterday about the proliferation of AI agents at enterprise software companies. Snowflake is one company that sits at the center of that trend. This month, the company launched Snowflake Intelligence, which houses another group of agents aimed at businesses. Joining me now is Jeff Hollan, head of Cortex AI agents at Snowflake, to tell us more about his vision for the offering. Jeff, welcome to TITV. It's great to have you here.
Yeah, thanks so much for having me. It's an honor.
So let's talk about Snowflake Intelligence. What is it?
Yeah, so Snowflake Intelligence is our effort to help it so that every organization can more easily get everybody on the same page. We're often finding across many companies, like data is everywhere. There's so much data scattered across Slack conversations and documents and you name it. But actually having the ability to gain insights, understand what's happening of how are we trending towards our revenue? What is my sales pipeline looking like? Can be really difficult. Often you're stuck by looking at something like digging through static or stale dashboards, or you're calling your analyst team and you're hoping for them to do manual analysis. We want to empower every individual in an organization, whether you're the CEO or you just joined a week ago, to have instant access to all of the data across your organization to make better informed, more intelligent decisions. And this is all powered by agents behind the scenes connected to your data through Snowflake.
And how are you pricing it?
Yeah, so Snowflake has actually been known for a while of a very generous pricing model, which is we are pure consumption based, which means we do not recognize revenue unless our customers recognize value. We actually took the same approach, which is quite differentiated in Snowflake Intelligence, which means you could roll out something like Snowflake Intelligence to your entire organization. You only pay when those agents are actually working. So if nobody's asking a question, there's no cost for you in Snowflake. You're just paying for those tokens, those LLM calls that are happening only when customers are actually finding value.
I'm curious, did you build this all in-house or did it come from any of the technology that you've acquired recently?
So it's a combination of a few things. Snowflake has a few key partnerships in terms of underlying large language models themselves. So Snowflake securely can run things like OpenAI's GPT-5 or Anthropic's Claude 4.5. Those act as the underlying models. In terms of the ability to accurately find and retrieve the right data to give to the user, there's actually a few acquisitions that have happened. Neeva was a few years ago at this point. That has some of the core search technologies. Truera was a little bit more recent. That's around quality of some of these agentic pieces. And then a lot of the additional layers on top. How do we make it so agents are really, really good at understanding the complex, massive data sets? I mean, think of Snowflake. These are global 2,000 companies. These are huge organizations. So we have built a lot of things in-house over the last year and a half to make it so that these agents are really effective, even when looking at massive data sets.
You talked about using models from OpenAI and Anthropic. We've talked a lot on this show about how expensive it is to use some of these models, not just at those two companies, but models at large are pricey. Are these agents profitable for you right now?
I mean, we don't disclose anything in terms of like our underlying margins for these pieces. I would say that we've got really good agreements with each of these providers in terms of making sure that we can get good economics on our side. And then we do everything we can. Like our goal, truthfully, I'm on the product side, is we want to reduce as much friction as possible for our underlying users. So we're not out here trying to nickel and dime people. We truly are like, there's a real cost, to your point, of these large language models. These things do require some real beefy, heavy GPU compute, but we're really happy with the agreements that we have with these providers, with the cloud infrastructure that we're running behind the scenes. We're trying to push as many of those benefits to our customers as we can, which is part of why I mentioned a bit ago too. We're actually offering this as a consumption-based offering, not requiring you to have some like fixed per seat costs, which is usually the norm with some of these AI agent technologies.
I want to zoom out a little bit and look at the enterprise software sector at large. We had our enterprise software reporter on just yesterday, Aaron Holmes. He wrote a story about how all these agent offerings at enterprise software companies are really starting to converge, and they're starting to step on each other's toes in a way that we actually haven't seen in quite a few years. As you think about that, how do you think about how Snowflake Intelligence differentiates itself from the dozens of other enterprise software companies that seem to be offering something very similar to the language that you just used?
Yeah, and the thing that I always often like to talk when I'm talking to organizations about this is our goal at Snowflake. We're not trying to build an agent that can do everything. And of course, like there's so much excitement, real understandable excitement around agents right now. To your point, so many technology providers right now are creating their own agent offerings. Our position is saying, hey, look, this isn't going to be the agent that does everything for you. What we want to make really easy and really effective are specifically agents that can look into and understand your data. Like data is the blood of Snowflake. That's our core. That's the thing that we are really, really good at. So the way that I see things moving forward is that you will see these combination of agents in an organization, but we're moving towards more of this world where those agents are going to act more as an ensemble, an orchestra together, where when you're accomplishing a task, maybe part of your task is you need to go open up a job rec using your job portal. Well, a Snowflake agent's probably not going to be the best one at doing things like opening a job rec. Maybe your Workday agent is going to be the right one for that. But any time in that process where the job to be done is, well, I need to understand what's happening, right? What does my employee turnover look like? What does my revenue look like? What does my sales pipeline look like? Well, that's where you're going to want to use the Snowflake agent. That's where we're saying, hey, we are really, really good at this. So there is a bit of overlap. You see all these agents coming together. I see them working together more in concert over time. And our aim is to add the most value we can, especially on that data understanding, data insight piece.
Let me ask you, Snowflake hosted its Build conference. I think it was last week, earlier this month. As you think about the conversations that happened at that conference this year, how did those conversations on the ground differ than what you saw last year with customers?
I think the biggest difference to me that's very exciting is this is becoming very real. Like agents was buzzed about in 2024. Maybe there were some early adopters. Now we're seeing this rolled out in large ways. I was able to get joined on stage with companies like Fanatics or Podium, and they talked through how they're rolling out dozens of agents in their organizations. Fanatics was awesome. They're like, look, our goal is to provide the most optimized, personalized fan experience that we can. We have all of this data in Snowflake to help us understand so much about our fans and what they're doing. Now we can layer on.
Are they seeing ROI from that investment in agents?
Absolutely. Like, and this is the exciting
real profitability.
I mean, the Fanatics didn't disclose profitability numbers. I can't speak for them, but in terms of, is this adding real value, right? Are our employees more productive? They shared an instance where they have an executive who want to understand, look, should we be doing this marketing campaign? How can we understand better our different fan bases? Things that previously would have taken days, if not weeks to understand. They're like, well, let me open up Snowflake. And literally within 45 seconds, they got deep analysis. So that type of value, it can be sometimes hard to quantify, right? Like, how do you quantify the 3 weeks of time that would have been spent? But seeing that value and seeing this actually happen in production, to me, is where we're happening now. Like, that's what gets me excited about the last Build conferences. We're going beyond the hype to finding what are the areas of real value that people can find.
Great. Well, Jeff, I want to thank you for coming on the show. We really appreciate it and hope to have you back again soon.
Yeah, anytime. It's been great. Have a great one.
Okay. September was a record month for EV sales with 2.1 million vehicles sold worldwide. That is according to research firm Row Motion. A big factor, U.S. buyers racing to take advantage of expiring tax credits. So in an era where electric vehicles are no longer a niche experiment, but rather a mainstream reality, the question is, who is building the charging infrastructure to keep up? Joining me now is Olga Shevorenkova, CEO of Loop Global, one of the largest EV charging networks in the U.S. Olga, welcome to TITV. It's great to have you here.
Hi, thank you for having me.
So let's talk about Loop. Tell me about the charging infrastructure product that you have and who your customers are.
Yeah, so we have two main products. One is we call L2, a slow charger. And the main client or the main customer for that is multifamily or office building. So you charge your car in 8 hours while you're sleeping at home or while you're working in the office. That's our primarily product, and multifamily would be the most, the locations where we sold the product the most. Our second product is our DC product, a fast product, which allows you to charge your car in 45 minutes. And the main customer for that product will be a retail location, like a grocery store or a shopping center, where people don't spend as much time as they spend at home in the office, but they want to charge their car. So those will be two primarily products and two primarily segments we're targeting.
And with those two segments, which segment is giving you the most revenue right now?
This is a very interesting question. If we're thinking about the hardware sales, because we sell our product, then the fast charging product is picking up very fast because it's much more expensive. So you sell less of them, but you get higher revenue. But if you're talking about recurring ongoing revenue, which is a software subscription and revenue share, then of course it's our historical L2 product because we just deployed so much of it.
So between the two right now, hardware is still generating the most revenue for you.
Yes, today, yes.
And how much revenue is the company generating now?
So we are not a public company. So we don't disclose our financials. Sorry,
but I can ask. I can ask.
Yes. We've deployed nearly 8,000 ports over the life of our existence. Axios article recently estimated that we're number 4 in the United States of America. The first 3 companies are public, which will be Blink, ChargePoint, and Tesla. So anybody who's interested can infer by looking at their financials. Once we go public, then there won't be a secret.
Are you going public soon?
No.
No.
We don't. Today's markets are open for that.
Well, I want to talk a little bit more broadly about how the electric vehicle story has changed over the past few years. I wonder how your business has been impacted by the current regulatory environment with the U.S. around electric vehicles. We talked a little bit about the credits. How are you dealing with that on the ground?
Yeah, so there were two primarily things which the current administration has done is slashing the federal incentives and slashing the actual tax credit to a driver. We were not affected by federal incentive because we were never targeting that market. That federal incentive primarily incentivized the rollout of infrastructure alongside highways. That has never been our market, so that really did nothing to us. The incentive, which, as you very correctly pointed out in your introduction, is about to expire, will probably have some indirect effect on EV adoption and on us as well. But what I can say is that the market has been the growth hasn't been as fast as people forecasted already for a couple of years. The market's been growing, but it's been growing probably in a high single digit, low double digit % year over year. And everybody expected that the market will like double every year. So a lot of people were disappointed. But primarily driver for that wasn't the incentive or administration change. It's simply a high interest rate environment, which usually slows down spending on layout of projects, and it has all kinds of connotations to the economy. So I'm quite optimistic that now when we're entering the era where the Fed start cut the interest rates, we'll see the market picking up faster. What effect the tax credit will have on EV sales is unclear yet. I think everybody's trying to understand that. What I see, though, from research, and I've been in this market for over a decade now, what I see from research is that the main driver for people to buy an EV is not the regulatory incentive, is not the affinity for sustainability, anything like that. It's simply a consumer preference. The EVs are better cars to drive. And that's very different from 10 years ago. Like 10 years ago was a very different audience. Today, we're entering into mass market where people just love driving EVs. EVs are fun. There are new models coming out. And once you've tried one, you never go back. So there is a fundamental driver as a consumer preference is a fundamental driver.
So what I'm hearing from you is that when you think of the biggest bottleneck right now to EV adoption, from what you see, it's not consumer preferences, it's the macro trends that are actually preventing people from buying it. Is that what you're seeing on the ground?
I'd say the main hurdles to EV adoption are still OEMs haven't introduced the mass market model, which would be at cost with, like a Toyota Corolla or whatever, like the mass market vehicle. So a lot of people who buy EVs today are people with higher incomes. We're living in a big, still rich country, so it's a lot of people still they drive the market.
Pricing is still the biggest hurdle.
Pricing, and it's not that they're priced. If you take a Mercedes vehicle, they price the Mercedes electric and Mercedes gas are priced similarly, but you don't have that in the Toyota Corolla or any other mass market vehicle segment just yet. Though I know that a lot of OEMs are working on introducing it. Once that happens, it unlocks tons of sales from my perspective. That's one hurdle. The second hurdle, you still have that range anxiety, and that's what me and the companies like Loop are working on, where people are like, okay, I buy an EV and I can get from place A to B. What if I get stuck and all of those things? But we see, I live in California. California is leading EV adoption in the US. We see that in California, that factor is going away because there is so much charging available, especially if you live in large urban center like Los Angeles or San Francisco, San Diego. That is alleviated, and that's where we see EV adoption is picking up much faster because people know, they see it with their own eyes at every grocery store and every hotel they're going to.
Let me ask you this. We saw the news this week that Waymo is charging ahead with their own ambitions. They're putting their cars on highways now. A lot of people are talking about autonomous vehicles this week. How does the advent of autonomous vehicles and the boom that people are forecasting there, how is that going to affect the EV sector and your business?
Very positively. Pretty much to my knowledge, every autonomous car, be it Waymo or any of their competitors, is electric because it is much easier to operate remotely, right? To start and go, and it has all this electronics built in. So those cars drive, like an average, just a normal commuter drives 11,000 miles a year. The New York taxi driver drives like 60,000 miles a year. Waymo car will drive like 120,000 miles a year, right? So if you drive that much, guess what you need? You need charging, and you need a lot of it. So that's a very positive development from my perspective for EV sectors.
Are you talking to these autonomous vehicles companies right now, doing any partnerships with them?
That's not where we are focusing today at Loop, because our focus again is multifamily and retail, but that's something we will start doing once they really widespread.
Right. Let me ask you one question before you go. You've been in this sector for more than a decade, in the sustainability sector for even longer than that. I wonder if you reflect on where you started, when you were starting out, and there were all these forecasts coming out probably about EV adoption and how quickly it would take for everybody to have one. Here we are now in 2025, and we know that it's growing, but it's not everyone. I mean, it's still work to be done. When you reflect on where you expected things to go 15 years ago, how do you think about that? Did it live up to your expectations? Is it faster or slower than you thought?
When we think about 15 years ago, it's definitely faster. I don't think anybody I don't think I could have imagined that I would be driving an electric vehicle 15 years ago.
Really? So nobody was saying then, nobody was,
No, everybody was talking about solar and wind when you talked about sustainability. It's solar and wind, and then batteries showed up, and EVs was like this toy. And I remember in my career, we had this intern who was tasked with EV charging, and everybody thought it was just some toy project. Nobody cared. But then it kind of popped up. So I think if you compare it 15 years ago, we're definitely with autonomous, with EVs, with all those like mobility infrastructure 2.0, we were much further ahead. If you compare it to 5 years ago, because then everybody's expectations shot up. If you compare it to 5 years ago, I think a lot of people, as I mentioned earlier in this conversation, feel disappointed because they thought, okay, by 2025, everybody's going to drive EV or whatever, 40% of people. But that hasn't happened. So I think the sentiment was just non-existent a decade plus ago. Then everybody decided this is it, this is happening now. But it's happening at its own pace. And if you think about numbers, today there are 5 million EVs, pure EVs, not hybrids, just pure 100% EV vehicles, passenger vehicles in the US, out of 170 million. So we are in a few percentage point. I think it's a pretty good critical mass. It definitely shows we're getting there. It will take us a couple decades to get to 50% plus. But again, as a vivid EV driver, I cannot imagine going back to the ICE vehicle. I cannot imagine going back to a gas station. That's a nightmare. And I would imagine a lot of other people feel the same way.
Whoa. When was the last time you were at a gas station? Very quickly.
With my husband, he still drives an ICE vehicle. So sometimes I go.
Well, there's the adoption. There's the adoption curve right there. He's the first person you have to convince.
I'm working on.
Great. Okay. Well, Olga, thank you for coming on the show. We really appreciate it. And when you convert your husband, we'll have both of you back on the show, and you can tell us about how exactly you convinced him. Thank you so much for coming on. We appreciate it.
Bye-bye.
Okay. We talked last week about the information's 50 most promising startups for 2025. As a reminder, this list has a pretty great track record about forecasting which startups have gone on to do quite well. Already, just a week later, one startup from this year's list has announced a big new funding round. Foxglove, a robotics software company, raised $40 million, led by Bessemer Venture Partners at a $150 million valuation. Joining me now to discuss the news is Rocket Drew, our AI and robotics reporter, and Foxglove CEO Adrian Macneil. Welcome to the both of you. It's great to have you here.
Thanks, Akash. Glad to be here.
Hey, thanks, Akash.
So, Rocket, I'm going to come to you to talk about robotics, but Adrian, I want to start with you. The name Foxglove, how did you come up with that? Because this is a running theme with robotics companies. Last time we were on the show with a company called Pickle Robot, I think, if I'm right, Rocket.
Right.
And we asked him why it was called Pickle, and I honestly, I don't remember the answer. What is the story behind Foxglove?
Yeah. Pickle was a good one. I mean, Pickle was that's a funny story because that's kind of a play on words. They're picking parts and things like this. I was actually at their office quite recently, and there's just green everywhere. Like all of the conference rooms are named after like types of pickles. They really.
I think you just explained it better than he did, Rocky. What do you think?
He also likes green,
Right.
Yeah,
okay.
yeah.
So what's the deal with Foxglove? Do you also have names of conference rooms with different variations?
Yeah. So Foxglove is it's actually a flower. It's a wildflower. here's my thing with names, right? I think that names become whatever you give them, basically. And so I don't actually like having a name that's directly like too literal what you're doing as a company, because what you're doing changes. Especially, we started this company 4 years ago. It's going to be a long ride. Companies launch multiple products, so I actually don't like having a name that is too literal about what it is that you're building. Foxglove, it sounds cool. It's actually a wildflower that grows in New Zealand where I grew up, and sounds awesome. It rolls off the tongue. More importantly, the domain was available. The Twitter, the name was available. Wasn't already taken, and you can say it. You can see it written down. You know how to pronounce it.
There you go.
You can hear it said. You know how to write it down. So that's my criteria.
I can't argue with it. It's a great name. I like it. Tell us about the more literal aspect of this. What does the company actually do, and what did you raise all this money for?
Yeah, so we build data infrastructure for robots and physical AI. We help companies with logging and collecting data at the edge on their robots, uploading, getting data off robots, which is actually a big challenge in the robotics space, because all of your robots are deployed out in factories or farms where you have terrible internet. You're logging all this incredibly dense data, sensors, video data, 3D data. You're logging all of that at the edge. You need to upload it. You need to bring it back to the cloud. And then the developers, the ML engineers, the software engineers need to be able to understand, to analyze, to debug that information. So they use Foxglove to store and organize all of that data, search through it, find interesting, relevant events, and then really go, 3 levels deep into the debugging and understand frame by frame what was actually happening in this scene. So if that's an autonomous vehicle, it's like, why did we slam on the brakes here? If that's a, picking robot in a warehouse or a logistics, thing, then we're understanding, like, why did we drop this item? If we're a forklift,
Right.
why did we back into this pallet? This is
So it's the software component to robotics.
Right, exactly.
Got it. Rocket, why did Foxglove stand out to you among all the software companies that you probably studied in robotics?
Well, truly, it was a story of happy customers, actually. As I was making my rounds and talking to people in the robotics space, multiple times I ran into people who were just very relieved to have access to Foxglove software, because in robotics, we talk a lot about data. It can sound like kind of a dry topic, but in robotics, data is gold. That's how you improve your robots. That's how you get the AI to actually power the robots to do all of these impressive things we see. But robots turn out so much data, it can be difficult to manage. So I kept coming to companies who were just like, it was a breath of relief for them to have software that could help manage the data for them. And I would ask people questions, and people would say, oh, that's a good question. You should ask this guy, Adrian, about that. So that's how I ended up learning about them.
So the customers are talking about you, Adrian. Who are your customers?
Yeah, we have like a very wide range of customers. So everything from small startups up to industry leaders, like big companies like NVIDIA using us, right down to earlier stage ones, Chef Robotics and Pickle Robots, which are both on, I think we're on the Information 50 list, are both customers. We have warehouse ones like Dexterity. We have a lot of self-driving customers like Wave and Wabi, a lot of the newer generation of self-driving companies. So a big range. Also aerospace and defense ones. So Anduril, Shield AI, Saronic. The full spectrum, really.
And tell me, you raised $40 million. What was the valuation you raised at?
Yeah, so 190 was the valuation.
190. Rocket, I want to come to you on this because we had Vinod Khosla on the show, and we were talking about valuations at large, and he talked about the bonkers valuations in robotics right now. $190 million. I don't have any way of putting that into context. It's certainly not the AI valuations that we're seeing, but it's still a big number. Talk to me a little bit, Rocket, about what you're seeing in terms of valuations in robotics broadly.
Yeah, truly, some of the valuations are astronomical. I think that it reflects investors' enthusiasm for physical AI right now, and reflects sort of the potential of physical AI to be the next frontier of AI moving into the physical world and doing real-world tasks for us in the homes and factories and warehouses and so on. I think when we were putting together this list, some companies were kind of priced out of our TI 50 criteria because they had already raised too much or they were valued too highly, especially companies that were building humanoid robots or developing foundation models, like developing one AI model to rule them all that will power a variety of robots. I think what's interesting about Foxglove in particular is because it's structured as kind of more of a traditional SaaS infrastructure business, it's able to play to that whole market, sort of like across the board, like Adrian was describing. But the structure of the business can be a little bit more like familiar to investors. They understand how the margins are supposed to work in a business like that, how to price that kind of software, and that can make it a little bit more, I think, familiar while still giving access to the whole field.
Adrian, when you were out fundraising, and I say this knowing that you are a software company and a lot of venture firms probably know how to handle software businesses better than robotics, but as you were out doing your fundraising, I wonder if you can talk a little bit about what proportion of venture capital funds actually have the expertise to invest in robotics, broadly speaking? Because I've written this column before at The Information that when it comes to hardware and chips, actually, for example, not every venture firm is set up with the expertise to invest in something as technical as chips. When it comes to robotics, is it the same story, or is this a growing proportion? How do you think about that?
Yeah, exactly. I think a lot of investors, a lot of traditional VCs that mostly invest in software are, I would say, robotics curious right now. I had a lot of conversations where people said, we've been looking into robotics. You know, we heard Jensen get on stage and say physical AI is going to be the next big AI. We're looking into it. We're talking to everyone, but you know, we don't invest in hardware or something like this. I'm excited about robots. We don't invest in hardware. You're going to have to square that circle somehow. We were very lucky. We started the business in 2021, and you know, at the time, most of the investors were say, "Hey, we're going to go build developer infrastructure for robotics industry," and they're like, "What robotics industry? What are you talking about? Like, why aren't you starting an NFT business?" And so we got down this train very early on. We were lucky to partner with Eclipse, who have been investing in hardware and robotics and these types of businesses for almost a decade now. So partnering with them was great because they had strong conviction in the industry. This most recent round, there's definitely a lot more interest out there in robotics and physical AI. And like I said, we're lucky in some senses that we're building a traditional developer infrastructure business. So people are kind of familiar with, SaaS margins and pricing and things like that. But yeah, I would say that there is still a lot of, we are probably the largest and company in this growing sort of developer infrastructure for physical AI vertical.
Akash.
And
Yeah.
it's definitely new to a lot of investors. So it's something that we had to sort of educate people. There's still a lot of, I would say, people unsure about like sure, we believe robotics is going to be big, but like how big?
Right.
I mean,
Rocket, what do you see here?
Well, I've got to tell you a quick anecdote about this. I mean, Bessemer has invested in hardware before. They're not totally, new to this space,
Right.
but when they were doing their due diligence on Foxglove and considering an investment, they got together in the New York office, and one of their investors put a Raspberry Pi on a toy car and then drove it around the office and collected data off the self-driving car using Foxglove software, and then visualized what the car could see using Foxglove software. And that was part of how they tested the product, was just to drive this remote car around the office. I thought that was excellent.
Wow.
Yeah, that was actually awesome to see. I mean, as a founder, you get a lot of a lot of outreach from VCs, and it can be difficult to tell like who's serious and who's just kicking the tires. But yeah, Bessemer showed up with, they actually sent me a selfie of them with this like little toy car that they'd set up in the office, and Foxglove running in the background.
I'm going to venture out to say that was a more compelling pitch than the VC that said you should be starting an NFT business in 2025. Well, I want to thank you both for
21.
Yeah. I want to thank you both for coming on. Adrian, congrats on the funding round. And Rocket, I look forward to seeing all of the companies from your list that continue to complete these funding rounds. Thank you to you both. It's great to see you.
Appreciate it. Thanks, Akash.
Well, that does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I'm already excited for our next show tomorrow. Have a great rest of your Thursday. Bye-bye for now.